Hello and welcome to Fidelity Connect. I'm Pamela Ritchie. The markets moved in a historical way yesterday. A massive reversal was seen, and it marked a surge after Trump announced a 90-day reprieve on some of the reciprocal tariffs. Now, today, markets are lower as investors remain cautious, recognizing that volatility may well be far from over. Still, some analysts, like our next guest, see opportunity in some of this chaos that we're seeing, pointing to historical patterns that suggest sharp downturns can certainly sometimes pave the way for very strong rebounds. Joining us here today for another impactful edition of Sector Watch is Fidelity Director of Quantitative Market Strategy, Denise Chisholm. Hi, Denise. So great to see you. Thank you. Good heavens for seeing us here today.
Hi, Pamela. It's great to be back.
Where were you when you heard about
I
this?
was right there at my desk watching the headlines.
It was explosive. It was incredible to watch. We were going to talk, and we will talk about the speed at which markets can move and what that ultimately can mean. But I just have to ask you first. I mean, why do you think we saw that reversal in policy yesterday? I mean, just give us a little bit of what you gleaned.
Yeah, I mean, I think that in some ways, policy can only, the US economy can only take so much of a hit. So, in some ways, what we didn't see was a total reprieve on tariffs. We saw a shift, right, from reducing tariffs on everyone else except for China. I think across the board, tariffs being raised at some point, as we discussed, I think can be a hit to GDP, which obviously runs counter to any goal in mind of deficit reduction or anything else. So I think the policymakers, in some ways, intrinsically acknowledge that.
Right. Okay. And I mean, and that is ultimately what we saw. I mean, give us a sense of what suddenly looked interesting to investors. I mean, we saw the markets rally, 8%, massive. We know sort of the historical context of that. What sort of looked good when the tide went out? I mean, what was the classic area that was of interest to you as you're looking at sectors?
Yeah, it's interesting. So you always do have to be interested as an equity market investor. I mean, I think if we back up, we talked a lot about the impact of tariffs and how you can quantify it because as much as we've never seen tariffs before, we've seen a whole lot of shocks to the US economy. Now, we'd have to make some guesses on how tariffs end up impacting corporate profits or the US consumer from a tax hit perspective, but you can make some guesses and compare it to other headwinds that we've seen. And I do think that that's the unique part. And remember, we talked about you'd have to see something very, very high around the tune of 30% to really see a significant shock to the US consumer. And they came in at the high end of the 20s originally. So that was sort of the market, interestingly enough, reacted almost instantaneous on that news and priced in what I would call 70% of the way through a recession.
Wow.
And this is the interesting thing. Remember, the point at which the peak to a correction, 10% down, was the fastest we've seen since 1900, and to almost a bear market, and I'm going to call us bear adjacent because we got there intraday, but we did not actually close at bear market levels of peak to trough 20%. That was actually the third speediest to bear in since 1957. So this is the interesting part about sort of bear market analysis is that now because we moved before any of the data, we don't know the hit to earnings growth. We don't really know the hit to the US consumer. Now we're in this situation where you're 70% of the way through pricing it into recession. And now the math might change. So we always have to be open minded as equity market investors that it can go either way. It can certainly get worse, and you always have to acknowledge that that could be the case. But it could also, because it was a policy shock, the policy shock itself might actually improve. So, of course, none of us know. And I actually wrote a note internally that was titled, Nobody Knows Nothing About Tariffs. So I look for the patterns in the data, to your point, where potential opportunities. And there are a couple interesting spots about what we saw in terms of the speed to bear. So when you look at I think it's 14 or 15 bear markets since 1957, you see a really strong correlation between the speed to the decline and then upside on a 1 year basis.
Wow.
So X the really long recessions of the 3 to 5 year bear markets of 1973, 2000, and then 2009. By the way, it took those to get over 250 days to a bear market.
Mhm.
All of the other bear markets and bear adjacent markets like 1998, 2001, even 2018 was one, 1990 was one, the Gulf War, 1957, 1962. Some are recessionary, some are not recessionary. But if you're just willing to take a stab, once you're down 20%, 80% of the time, including even those secular bears, you're up over the next year. And most of the time, you're up over the next 2 years. So time horizon is always key for equities because if you look at, do we know that that's the low? No, we do not. Most of the time, it's actually not the low. You go lower by an average of 5%. So we could see a situation where this gravitates slowly lower as well. But I think that you always have to be open minded of what those opportunities are. The other second interesting part of the data was the level of the VIX
Oh,
relative to
wild.
the level of credit spreads. So again, credit spreads widened a lot, but we're only at median levels. Where the VIX was in the top percent of its history, going back to, we only have the VIX to 1990. But this is a very different setup versus what we saw in the financial crisis, where credit was waving the red flag, and even in 2000, where credit was saying, hey, we've got bigger issues here. So far, we're not seeing that. And that pattern is important, as is the bear market pattern. So then I think as an equity investor, what you want to be looking for is where you're seeing opportunities in all the dislocation.
Okay. So are there some glaring opportunities or where would you look to? It strikes you that, whatever was most highly valued and just got a lot of their multiples wiped out might look interesting again. But where do you look right now?
Yes, so absolutely. So we've talked a lot, and I think that my top two sectors are financials and consumer discretionary. But technology is, we haven't really talked about it a lot. I always thought it was a positive risk reward, but more and more that is where you saw the multiple compression,
Mhm.
right? So especially in software companies. So that was a really intriguing area that I just got my monthly data where you've seen a really strong multiple contraction. So now all of a sudden, stocks that have been high margin businesses, have been high quality businesses, are relatively less exposed than potentially other areas of the supply chain. And now you're seeing them trade at a 40th percentile on relative forward price to earnings. So this is actually what I'm looking for as an investor, because ultimately, if you get the earnings wrong, and of course we don't know what the ultimate tariffs will be, there might even be more tariffs coming. So you don't know what the ultimate earnings growth will be. I think that that's where valuation is your friend. And when you can look historically and find that valuation offers outperformance, at least statistically speaking, whether or not earnings goes up or even potentially contracts, that's where I think you get a positive risk reward. So software sort of rose, 5 ranks in my ranking list in terms of the dislocations that we saw over the peak to trough contraction.
Is software also strikes me as, I mean, it's not really good. It's mostly services, which is not what the tariffs are on broadly. So it has that kind of less exposed, plus obviously the multiples got blown out.
Yes, it is relatively less exposed on the supply chain end. I mean, everything is exposed on the,
Yes.
ultimately, to
Yeah.
the extent that the shock is big enough in the U.S. consumer, then ultimately all of corporate profits are exposed. And that's why I always focus on the hit to the consumer, because that's the difference between a 5 to 10% headwind for corporate profits, which you can live through, and something that looks more like 25% contraction on average in a recession. And that's why this distribution is so important, because as it sits now, we did a tariff shift. I think you can kind of call it a 600 billion in tariffs loosely, although the people in the know, when you start to read through the details, are finding more and more exceptions. So that $600 billion number is actually coming down a little. And again, we'll see. I mean, there could be more tariffs on semiconductors, more tariffs on pharmaceuticals, although there could be less tariffs on China if there's a deal, or even less universal tariffs if there's a deal with Japan. So again, you have to sort of hold all of these things together, which is to say that we don't in fact know. But if you think about that 600 billion, and say about 300 billion ends up on the US consumer, the US consumer has about 25 trillion in income. So that's a little over a 1% hit to spending. The irony is, when you really look through the data, we've seen 1% tax hits before: 1968, 1993, 1982. And if none of those sound recessionary, they're not. It was actually 1983. they're not recessionary historically. And those are direct hits. So literally, your taxes go up, your withholdings go up, you lose money. And yet, consumption actually stayed positive throughout, which isn't to say that a 1% headwind is a piece of cake to walk through, but it usually is that you have to think about maybe some other offsets. And again, sort of holding all else like we don't know what we don't know, what could the offsets be? Could
Right.
the offsets be a tax bill sterilization? Could the offset be the decline in energy prices that bolsters the consumer? Could it be a decline in interest rates that bolsters the consumer? So there are all these things. A 1 to a percent, a little more than a percent headwind actually can be muddled through. But if you start getting into that, what we talked about, 1.5 to 2.5% shock, to the extent that these tariffs become escalational or being retaliatory, to the extent that you get in that zone, that is the danger zone. We obviously haven't seen that impact from tariffs in our lifetime, but we've seen it before, usually in oil prices and usually in rates. So that's the danger zone. That's where I think you have to think about as an investor, potentially repricing recession.
Speaking of either off ramps or offsets, we saw that OPEC made its move. I think the day after
Mm.
April the second. It's all a bit of a blur right now, but um, I mean, oil prices are off massively. So there is that, and you were pointing to that earlier as well. But it's only become more so over the course of the last week. So that just speak to some of those offsets, as you said. You mentioned a tax bill, sort of the sterilization, that kind of protection it could create from taxes. I think everyone's waiting for deregulation and for, for tax cuts. But take us into that a little bit right now. What's looking more and more possible?
Yeah, I'll give you my math. Again, I think that it's stress test math in the sense that there's no absorption of exchange rates, there's no absorption in the foreign producer. So those $600 billion of tariff, 300 billion ends up on the US consumer, 300 billion in corporate profits. That's about a 7.5% headwind to corporate profits. Again, manageable unless the consumer buckles. So we've got 300 billion in headwinds coming at the US consumer. What are some tailwinds? Well, that peak to trough contraction we've just seen in oil prices is actually, about $100 billion of a tailwind to the extent that it stays here and it's below $60 today. So that's not insignificant. And there's talk we'll see in terms of what was passed in the Senate and then what's being passed or argued over in the House. That actually could be another $150 billion of incremental tax cuts, with no taxes on tips, no taxes on Social Security, and no taxes on overtime. So we'll see how that goes through and if it nets out against some reduced spending, which is what the Republicans want. But all of a sudden, now you see that math, like you can get there, which is that $300 billion headwind was completely offset with the decline in oil prices and potentially a tax cut that's coming. So that's what investors always need to know, is that you don't know what you don't know, and you never know where stimulus can come from.
Well, it's so interesting. And so we've also seen the idea of individual trade deals being cut all over the world,
Right.
up to 70 of them. Some of them have some real color on them. There's an Alaska pipeline deal with
Right.
Japan and others that has got some, it seems like some meat on the bones. There's being discussed more. But I mean, is it possible that you could just see, look, we want this, we'll get rid of the tariffs, but give us that? I mean, actual deals struck with that many countries?
I find it interesting that strategists always opine about how that they think that they know what the Trump strategy is or
Right.
this administration strategy is. I think that at the end of the day, none of us know. But it is interesting that consensus is that you couldn't possibly do 70 bilateral trade deals in 90 days. And we'll see. I mean, there's a lot of things that I would have never guessed you would see with this administration. So I think you always need to be open minded that that's possible, to the extent that they're trying to get specifically more LNG terminals built and a secure sales base for our LNG. Maybe it goes faster than you think.
Yeah, interesting. And therefore we sort of have to just stay tuned. Speak to the idea of just uncertainty. Some of it has been relieved, and we know that. So there's maybe a little bit less uncertainty. But 90 days just sort of drags you through another time period on some level where no one really wants to adjust to a new reality yet. Again, how do you sort of, as an investor, take that?
Yeah, so I've said before, like high uncertainty levels are actually good for equity investors in the sense that usually there's one way to go, which is once you're at peak uncertainty, the improvement in uncertainty is usually positive for the equity market. Always remember that equity markets bottom on bad news. This is why this is so difficult. Bottom on bad news, and then the news doesn't have to be good. The news just has to get less bad. And that usually provides support to equities. I will say that I have a little bit of an out of consensus view that I hear mostly from strategists, some internally and some portfolio managers internally, and then some externally, that the uncertainty overhang is going to be an overhang for corporate America. And because no one knows the rules of the road, everyone is going to be reluctant to spend. And I don't disagree with that empirically, but already you have seen that corporate America has not spent. So if I look at CapEx, over the course of the last year in core capital goods orders, it's flat. If I look at hiring over the
You mean
last year,
prior to all this, like up to a
it's
year
flat.
ago,
Exactly.
into
Exactly.
another like back into the other administration, Biden administration, it was
Right.
still.
Before we even talked about tariffs, people were not spending and hiring. So I think that it's right to consider that, but I think that that is already what we are experiencing, and which is why I focused on the consumer, because what ultimately will determine what corporate America does in terms of that spending and hiring will be is if we see a recession or not. That will be the difference. To the extent that consumption is sustained, they can say, oh, it's very uncertain, but they will absolutely produce to meet end demand. So that's why I focus on that as opposed to uncertainty, because uncertainty is usually at the point at which you see peak uncertainty, you've already not spent. And that is exactly the situation we find ourselves in. So I'm not sure empirically it would be something that I would bet on as a headwind to corporate profits.
You mentioned other recessions and gone through some of them. There are comparisons being made to the GFC, to COVID. Those are both situations that I think you've said, no one had as many reins over it. Like it wasn't easy to just stop a pandemic, obviously. And the GFC had its own reasons why you couldn't really slam on the brakes. This is different. How different?
Everything is different in this, let's call it crisis, but every crisis or recession or bear market has its own idiosyncratic issues. I think that that's why a lot of people are saying, yeah, but you can't find any analog for this. And you can never find any analog for anything. I mean, COVID was different than the financial crisis. Remember, in the European debt crisis, which is again bear adjacent,
Forever.
we thought that the EU was actually going to disintegrate. I remember being in the business in 1998 with LTCM, and it was not clear at all who owned all the Russian debt and what that would mean to the financial system. So there are all these scary events. You can go back to 1962, the Kennedy slide, 1957, the Korean War, the Cuban Missile Crisis, on and on and on and on. And that's why every situation is dramatically different, which is why it's always interesting to me that you find all these interesting patterns that exist despite the differences. And again, going back to that speed of the decline, it usually means this is a little bit more like a crisis or a panic or a war. In some ways, as much as we are worried about the structural ramifications, the market has not acted as if it was a structural ramification yet.
I
The
mean,
market has
earnings are
acted.
coming like hours from now. So maybe
Correct.
we'll see something. But
Correct. Now, I mean, I think that at the low, I mean, obviously, we're not down 20% anymore, but that's the interesting part is like, well, earnings is going to be the next shoe to fall when corporations withdraw guidance because, of course, they have no idea. And we'll see. I mean, again, stocks, I think, discounted when I look mathematically of about a 10 to 15% earnings correction. So you're going to get this disconnect between you might get bad news, like you might even get a negative, you're likely going to get a negative quarter of GDP, and you might even get two because of the pull forward demand and tariffs. And you might get an earnings season where there's no guidance. And that sometimes after a 20% decline is typical, but not a problem for the equity market.
because they've already seen through it to an extent, or part way through it at least.
Correct.
When the pull forward stuff is going to be interesting because I mean, even back in December, we were reading about copper being delivered from ports in the UK into the US to get into the warehouse quick, get the taxing done ahead of everything. There's a lot of pull forwards in a lot of different industries and sectors. I wonder how that will look for comparables. Is it going to be hard to read the data for a bit?
I think it's going to be very hard to read the data. And in some ways, it created a buffer for the consumer and producer so that tariffs wouldn't be an impact for at least, let's call it, a quarter, maybe two. So you're going to have this air pocket where you've already pulled forward all your demand, and therefore demand is likely quarter on quarter to decline, and maybe even quarter on quarter again to decline because you built up your inventory so much. So what's going to look like really, really bad news is just if you average out the bulk of the quarters, is probably only going to average to slow growth. So I think that you're going to see a lot of headlines of recession and even potentially two quarters of GDP, but it's not quite the same recession unless we see corporate layoffs. That's, I think, the glaring difference between GDP growth and averages in GDP growth and a true recession where corporate America starts laying people off.
That's going to be the big piece. Um, from back to the policy piece of all of this, China is the one that's very much in sort of this one-on-one argument with the Trump administration right now, and we don't really have any sense of where that's going. But retaliation is all over the place. Um, that and there's also discussions about whether American assets are being sold or not by Chinese investors and the government itself. Walk us through this a little bit. I mean, there was a widespread thought in the United States and on the election of Donald Trump that the deficit needed to be tackled. That was absolutely essential, and probably the Treasury Secretary took his job partially because that's what he wanted to help do. Just, I guess, walk us through some of the inevitability of at least the spirit of what's being done, if not the tone has different interpretations for sure.
Yeah, trade deficits are wider than they've ever been in the United States. And when you look back in the history, I used to do this for emerging markets, predominantly current account deficits, which obviously trade deficit is part of your current account deficit, is correlated to currency crises and bankruptcies when you look through history. I think that there has been a handshake deal where we will buy all of your goods, whoever you exporters are, and you will buy some of our treasuries, and we will run large deficits, but it will be sort of offset by your asset purchases, and this will go on ad infinitum. I think that there is concern that that's unsustainable just from an economic theory perspective. Now, in terms of changing it, we have tried to change it before in a lot of ways in this country, not via tariffs, but this is sort of what the Plaza Accord in 1985 was designed to do as well. Largely, some people say it was very successful, some people say it was partially successful. Over the long term, it did establish, certainly in the real effective rate of the dollar, it did establish a solid depreciating trend, which did reverse some of those trade deficits, although it was over the course of 10 years, not over the course of 10 days. So that is a difference. But in some ways, we have seen this trade rebalancing desire before. So I understand the economic theory, and it might be that you trade asset purchases for other asset purchases, like a pipeline or like any other infrastructure deals that the US is looking for. But I do think that the movement in the treasury market, I think it's interesting because there were certainly rumors that is it people selling US treasuries? I think that those are unconfirmed rumors. When I look at what the bond market did over a 4-day period, this was not particularly unique. We did see things like this in 2020. We did see things like this in the financial crisis, where the treasury markets were coming unglued a little, but we've seen it in non recessionary or almost non crisis periods as well in 2012, 2013, 2016, 2018, a bunch in the 90s. And it almost looks like a sentiment indicator where people, retail or maybe institutional, sells their treasuries to go to cash. So it's interesting from that perspective. I mean, yesterday's big reaction was, predominantly short covering, but it shows you how far sentiment has gone. And I think that sometimes sentiment indicators like that is that move up in treasuries might have been saying, I just want in cash.
So, what are your thoughts, Denise, on the U.S. 10-year treasuries and how the yield was rising over the past few days until this U-turn? Was the U-turn caused by the bond market? Right. Yeah.
So you were starting to see some dislocations in currency swaps. But I think broadly in the bond market itself from long term treasuries, like I said, it looked more like a liquidation event when I look through the data rather than credit stress. Always remember that the Federal Reserve's number one job is to step in when there's chaos in any credit markets. We even saw it with SVB, right? We were actually, I think that they were not lowering rates, but flipped from QT to QE to make sure that the banking system had enough liquidity. So always remember that if you see stress, that despite the fact that maybe inflation is a little elevated, we'll say, or that the Federal Reserve is worried about elevated inflation, their number one job is to be that lender of last resort and step into credit dysfunction.
You've spoken about technology, but more depth on sectors. You mentioned financials and consumer discretionary being sort of at the top for you. The question is about energy versus metals going forward, also technology, but your thoughts on these sectors.
Yeah, so financials, I think, is the deregulation story with a solid valuation backdrop. And despite the fact that credit spreads have actually widened quite a bit, you see that financials have actually acted a little bit defensive, which shows you just how strong that valuation support is. And I think how strong the deregulation story is. You're still seeing good credit out of the NFIB survey, meaning that small businesses are actually seeing like an increase in access to credit. I mean, we'll see if the tariffs actually upend that. But so far in the survey data is actually pretty good. And we're seeing the week on week loans continue to accelerate, even in commercial real estate. So I think that that backdrop of lending acceleration is still positive despite all of these consternations in the market. So I think that financials are a good risk reward place, as is consumer discretionary. I find that really interesting that, again, we're back to those cheap on free cash flow levels that have offered you 80% odds in the past. I know there are certainly parts of consumer discretionary that are in the crosshairs for margins. They're low margin companies with a big cost hit potentially from China specifically that is going to cause more of an earnings contraction. But again, back to that, some of that is priced into the valuation disconnect that I'm seeing in the data. So those are really two intriguing sectors. And I would say, again, within technology, I'm most interested in software. So not a lot of change in terms of what I think that you should be looking to own. But on the energy side, I was just looking at my energy charts because if you remember me saying my big bone to pick with energy is that you're still at top quartile, maybe not top quartile anymore, but top tercile margins, meaning that these companies have made a lot of money and are renormalizing from that, and they're now renormalizing at an even more rapid pace with $60 crude. We're not there yet on my numbers, but we're getting closer. Always remember that to the extent that we do see either a recession or a dislocation specifically in the energy markets, a demand decline is a buy signal. So most people will tell you, oh, that's really different because demand really never declines for energy prices. And it is. It's very, very rare, but it's usually a very strong opportunity. So I have my radar up for energy. What I would say is that I don't think that we're there yet. From a commodity perspective, I think gold is the most interesting risk reward for two reasons. And I would even say this for gold equities. Now, gold as the commodity, I think, has always looked better than gold equities, and in part because gold equities usually have declining free cash flow over time. So they're just not the best representation of gold. But when you look, what you see now is that relative forward PE of those gold miners is at the lowest levels that we going back in the data to the 60s. So I do think that it provides you some valuation support. And if you think, and I'm definitely starting to lean towards this camp, that real interest rates are likely to go lower and even potentially negative over the course of the next year or two, then gold has been very strongly correlated to the decline in real interest rates, right? So if the Fed sits through a temporary inflation spike, that basically is the definition of negative real rates. And to the extent that that spike becomes temporary, then we might actually see more aggressive Fed cuts, which is usually bullish historically for gold.
Oh my gosh, we should have started with that. That is so fascinating. We've run out of time. Denise Chisholm, thank you for that walkthrough of so many different components of what we're seeing right now and where the opportunities lie.
Always great to be here.
Thanks for listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/how-to-buy for more information. On fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on X. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently, and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks for tuning in. We'll see you next time.